Post the big-ticket acquisition of Arista Life Sciences last year, UPL has reported a subdued set of Q4 earnings. Now, while the operating performance excluding Arista remained healthy, the combined numbers remained impacted. Let's do a three-point analysis of the earnings fine print and the outlook on the company. 1. What are the key positives in Q4 earnings of UPL? Well, UPL excluding Arista reported a 15% year-on-year growth in the top line. Higher revenue excluding Arista was driven by a 7% year-on-year increase in the volumes as well as a 5% year-on-year uptick in realization and a 3% year-on-year benefit from the exchange rate. Now, while there was some disruption in the raw material supply from China, Latin America reported healthy growth. Now, the growth in Latin America was driven by strong growth in Sperto as well as Unicep products. Sugar beet portfolio and higher fungicide sales due to the wet weather in southern Europe pushed up the overall top line in Europe as well. The year also saw an inching up in the working capital due to spot purchases of raw materials from China. Now, according to the management, working capital is expected to go up further in the current year as well. Now, despite the ongoing trade wars, the performance in North America remained healthy, majorly driven by healthy sales in the herbicides portfolio. 2. What are the big concerns right now? Well, sharp uptick in raw material cost along with forex losses and write-offs in depreciation and amortization has led to a substantial contraction in the quarter's profitability. Now, the burden of higher debt taken from the Arista acquisition led to an increase in the interest costs as well to the tune of about 140 crore rupees. Now, domestic business saw a muted growth of a mere 4% year-on-year uptick in revenue due to erratic rainfall in monsoons as well. High inventory accumulation in North America is definitely a point of concern for the upcoming quarters as well. Now, drought-like conditions in Australia also impacted the performance in the region. 3. What's the outlook on the company going forward? Well, management has guided for an 8 to 10% revenue growth in FY20 for the combined UPL business with a 16 to 20% of the EBITDA growth. Now, management expects this merger to bring revenue and cost synergies in the next 3 years as well. The stock has gone up about 45% from its 52-week lows and is now trading at 18 times its FY20 expected price to earnings, close to its 52 weeks high. Now, we expect the performance to improve owing to the attractive lineup of the product portfolio. However, the company has substantial exposure in various geographies and anomalies related to the weather conditions as well as exchange rates definitely brings uncertainty to the company's performance. Now, acquisition expenses and higher leveraging could impact margins in the near term.